Forecasting in company analysis is the process of estimating a company's future financial performance based on historical data, economic conditions, industry trends, and strategic expectations. The program explains that forecasting is essential because valuation, investment recommendations, and risk assessments depend heavily on expectations regarding future earnings, cash flows, and growth. Analysts use forecasting to estimate future revenues, profitability, capital requirements, and financial flexibility under different economic scenarios. Effective forecasting combines quantitative financial analysis with qualitative assessment of industry structure, competitive positioning, and management strategy. Accurate forecasts improve investment decision-making by helping analysts evaluate whether market prices appropriately reflect future business prospects and financial performance. The forecasting process typically begins with a thorough analysis of historical financial statements and business drivers. Analysts examine revenue growth patterns, operating margins, working capital trends, asset utilization, leverage levels, and cash flow generation to identify relationships influencing future performance. The program emphasizes that understanding the economic drivers behind historical results is more important than mechanically extrapolating past trends. Analysts also evaluate management quality, competitive advantages, customer demand, and industry conditions to determine whether historical performance is sustainable. Historical analysis provides the foundation for developing realistic assumptions regarding future growth, cost structure, profitability, and financial risk within the broader context of company and industry dynamics. Revenue forecasting is often the starting point of company analysis because revenue growth influences most other financial variables. Analysts forecast future sales by considering factors such as market growth, pricing trends, economic conditions, product demand, competitive positioning, and geographic expansion opportunities. Different industries require different forecasting approaches depending on business models and operational characteristics. For example, cyclical industries may require forecasts tied closely to macroeconomic conditions, while technology firms may depend more heavily on innovation and customer adoption rates. The program explains that analysts must carefully evaluate whether growth assumptions are realistic, sustainable, and consistent with industry structure and competitive pressures affecting future business performance. Expense forecasting is equally important because profitability depends not only on revenue growth but also on cost control and operational efficiency. Analysts forecast cost of goods sold, operating expenses, depreciation, interest expense, and taxes using relationships tied to revenue, historical margins, or operational drivers. Some costs vary directly with sales volume, while others remain relatively fixed over shorter periods. The program emphasizes that understanding cost behavior improves the accuracy of operating margin and earnings forecasts. Analysts also evaluate potential changes in labor costs, input prices, regulatory requirements, and competitive pricing pressures that may affect future profitability. Realistic expense assumptions are essential for producing reliable earnings and cash flow projections. Balance sheet forecasting supports analysis of liquidity, solvency, and capital requirements. Analysts project working capital accounts such as receivables, inventory, and payables based on expected sales activity and operational efficiency assumptions. Long-term asset projections depend on expected capital expenditures, acquisitions, and depreciation policies, while financing assumptions influence debt balances and equity growth. The program notes that financial statement forecasts must remain internally consistent because changes in one account affect multiple areas of the financial statements. For example, higher projected sales may require additional inventory investment and financing support. Maintaining consistency among income statement, balance sheet, and cash flow assumptions is therefore essential for producing realistic financial models. Cash flow forecasting is particularly important because profitability does not always translate directly into liquidity and financial flexibility. Analysts forecast operating cash flow by adjusting projected earnings for non-cash items and expected working capital changes. Investing cash flows reflect capital expenditures, acquisitions, and asset sales, while financing cash flows include debt issuance, repayments, dividends, and share repurchases. The program emphasizes that strong operating cash flow supports business sustainability by funding operations, investments, and financial obligations internally. Analysts evaluate projected cash flows carefully because companies with weak liquidity or excessive financing dependence may face increased financial risk despite reporting strong accounting profits. Sensitivity analysis and scenario analysis are widely used in forecasting to evaluate uncertainty and risk. Sensitivity analysis measures how changes in individual assumptions such as revenue growth, margins, or interest rates affect projected results. Scenario analysis evaluates combinations of assumptions under alternative economic conditions, such as optimistic, base case, and recessionary environments. The program explains that forecasting inherently involves uncertainty because future market conditions, consumer behavior, and competitive dynamics cannot be predicted perfectly. These analytical techniques help analysts identify key risk factors and assess the range of possible outcomes. Understanding forecast sensitivity improves risk management and supports more balanced investment recommendations and valuation conclusions. Forecasting in company analysis is essential because investment valuation ultimately depends on expectations regarding future performance rather than historical results alone. Effective forecasting requires integrating financial statement analysis, industry research, economic evaluation, and strategic assessment into a coherent analytical framework. The program emphasizes that forecasting should support, not replace, professional judgment and qualitative analysis. Analysts must continuously update assumptions as new information becomes available and changing economic conditions affect business outlooks. Although forecasts will never be perfectly accurate, disciplined forecasting improves understanding of business fundamentals, valuation drivers, and financial risk. A strong forecasting framework enables analysts to make more informed investment, lending, and portfolio management decisions within complex global financial markets.